Hello, everyone, and welcome. Today I'm streaming from snowy Revelstoke in British Columbia. I hope you're having a fantastic week. So this week I'm going to do something, maybe I guess a little bit different, and kind of react to what's been going on in the market. And the reason I wanted to do that is basically every conversation that I've been having over the last few weeks, maybe even month or two, whether it be it with another venture capitalist, be it with a founder, has been, what are your thoughts on the current market condition? And what is it that I should do differently in light of that? And given how repetitive this has been, I've actually wanted to take the time to reflect on where we stand in the cycle, how things are going, and what people should do as a reflection of that. And so, without any further ado, let's get started in today's episode. Welcome to episode 35 of Playing the Unicorns, Thoughts on the Market. So as I discussed, what I want to present is what's been going on in the public markets, what's been going on in the crypto markets, what's been going on in the private markets in general, and the conclusions for investors, for founders, and maybe general thoughts of where things are going. So first of all, the public markets have corrected, and they've corrected in a pretty major way. So about a year ago, I wrote a blog post entitled "Welcome to the Everything Bubble," where I was describing or explaining that a combination of extremely loose monetary policy, essentially negative real rates, given reasonably higher inflation and zero interest rates, with quantitative easing by the Fed, plus extremely loose fiscal policy, was putting so much cash in people's hands that they were buying out assets left and right. And as a result, it was inflating asset prices across the board, and not just the stock market, but also the bond market, frankly, most derivatives, real estate, you name it, crypto, everything was going up, essentially with a correlation of one. And later, or in November, December of 2021, things started to adjust. So we've seen a pretty big correction in the S&P market, and the PE ratios in the S&P. That said, we're still above historical highs, so suggesting there may be ways to go. And as inflation fears have risen and the Fed has said they will increase rates, especially more risky assets like tech, or at least tech is deemed risky, have corrected dramatically. So in the NASDAQ, we have about 40% of the stocks of the NASDAQ that have fallen over 50% from peak to trough, which is a huge correction. I mean, the corrections we haven't seen since 2001, 2008, 2009, and of course in March, April of 2020. And what's interesting is this has happened essentially across every sector in when it comes to tech, which suggests, by the way, that risky assets are still highly inversely correlated with U.S. interest rates. So the higher the U.S. interest rates, the risky assets, the lower the value they have. And in a way that kind of makes sense, right? You would say, in theory, the value of any asset that generates cash flows is the net present value of discounted future cash flows. And of course, if your interest rate is zero, the cash flow each year, you can just sum them all up. It doesn't take a very big increase in interest rates to actually fundamentally change these valuations. And actually, as a result, we're seeing massive volatility. This is actually as of a few days ago. It's actually looks worse. Like, I think Delivery Hero might have fallen like 33% just today because of lower guidance. And I'll explain why there's much more sensitivity and volatility in markets like these where valuations are really high. In tech, it's happened across all sectors. So in prop tech, not just Compass, which is highlighted here, but like Zillow, Redfin, Opendoor have all seen pretty big falls, and fintech, all of them have fallen as well. In e-commerce, everything from Amazon, Wayfair, etc. And in food tech, I mean, Delivery Hero, DoorDash, Uber, to the extent that it's largely food as well, have all fallen dramatically, like Deliveroo, and in some cases like 70-80%. So very big correction in high growth stocks where the expectation of future cash flows is what matters most. And of course, if you're discounting these future cash flows more than before, it leads to a pretty big correction, right? Like imagine the interest rate is 10% to make math easy. You would say, okay, the cash flow in 10 years now is going to be discounted by whatever the cash flow is, divided by 1 plus 0.1, so 1.1 to the power of 10, given that it's 10 years in the future. So it's a very big decrease. Now, this extreme volatility that we're seeing is actually pretty typical in markets where valuations are high. And that's because it takes, if things are priced for perfection, it takes not that many changes to underlying expectations to lead to massive volatility. So we've seen a correction. It can still continue to go down. I don't make predictions on the future per se at large. Markets hate uncertainty. I think the question is what is priced in right now. So what's priced in right now is the Fed increasing rates five times in 2022 from complete historical low rates to still really low, actually. So how it plays out will have a massive impact given what expectations are, right? If this is like Volcker 2, we're raising rates to 10% to tame inflation, markets have way more to fall. If rates rise slower than expected, and if inflation comes down on its own, and I can make a bull case, things will adjust as well. And of course, there's a geopolitical overhang on top of this as well, where there's uncertainty over what's going to happen between Russia and Ukraine, and perhaps as well over China and Taiwan. Now, should there be nothing happen based resolved, I'm sure it'll remove uncertainty. Valuations there'll be some level of uncertainty lifted, and valuations will go up again a little bit. But frankly, even if there's an invasion, and it ends up being a limited action, and there's a new status quo, I suspect after a pretty sharp decrease the day that it happens, should there be a status quo that's determined as stable, then I think there'd probably be things would come back. Of course, if there's global thermonuclear war, none of this matters anyway, in which case we'll have bigger fish to fry. Hopefully none of that happens. I would much prefer that there would be a peaceful resolution and that uncertainty is lifted. And so we'll see how it plays out. That said, I can make cases for things going in both directions. Let me give you an example of the bull case here. Why would things correct? Now, part of the reason we've had very high inflation in the last year is we've seen in the US and in the UK an unprecedented shift in consumption from services to goods. People couldn't travel, people were not going to the movies, they were not going to restaurants, they were not getting haircuts. And with this extra disposable income they had, the savings just because they had nothing to spend it on, or the government was being generous with donations, they didn't know what to do with it. And so they bought a lot of things online. And that unprecedented shift in consumption from services to goods has actually put strains on the system. The infrastructure in the US is sadly a little bit decrepit and actually not very flexible. And there are many rules that are also like antiquated, like they're in the harbor and Long Bay. You can't actually stack containers more than 2 stories high, which makes absolutely no sense. There's very limited automation. There are rules around like when shifts can be worked. But as a result, our supply chains are not designed to handle such a massive shift in consumption from services to goods. And that has led to creakiness in the system, supply chain concerns, and it's led to inflation across the board, across all major assets. Now, imagine that because of Omicron, everyone gets COVID, plus a combination of more and more people are vaccinated. People decide, okay, this is kind of over. The next wave is not too bad. It may not even come because we've reached endemic level of immunity. And people start going back from consuming goods to services because mask mandates are over, travel restrictions are gone, etc. And we can make an optimistic case that maybe in 6 months, this is what happens. In which case, all the backlog of what's putting pressure on the demand for goods could go away. In which case, you can see inflation going back to the steady state ante, or like decreasing from that 7% plus to back to 1, 2, 3%. Allowing the Fed not to put so much increase in rates this year, in which case valuation expectations will change again. Multiples will re-expand as they're compressing. Now, on the other hand, if there's another wave and this continues and inflation stays higher than expected and the Fed tightens faster, then of course it'll go in the other direction. I think of the world in terms of probabilistic terms. I weigh different scenarios and different percentages, and you can make both a bear case and a base case. Now, again, I'm not a public market investor. I'm just commenting because about how these things are impacting the private markets and the crypto markets. Now, what's happened is interesting because with the rates being higher, multiples have compressed, and they've compressed in every category and some more than others. For high growth SaaS companies, we had a 37x revenue multiple, which is now essentially divided by 2. And in fintech, actually decreases up as much as 80%. In a way that kind of makes sense because in fintech, your costs or the cost of capital that you have for many companies, if you're, imagine you're a firm or Klarna and you're lending to consumers, maybe they haven't had the pricing power that they expected, and so they're paying a bit more for the capital. They haven't yet passed on those cost increases to consumers. So we're seeing pretty significant multiples compression in the public markets. Now, what's interesting is in Bitcoin, we've seen a very big correction as well. So that actually put to rest the ideas that, Bitcoin is an inflation hedge, it's completely uncorrelated. This actually shows that at least today, and maybe in the future that'll change, but at least today, the prices of crypto assets are really driven by the flow of hot money. And so they're highly correlated, in fact, inversely correlated with US interest rates and the ease of money. So when money is flowing easily, these assets have a tendency to go up. When interest rate expectations are going up, which means that the US T-bills become a more attractive asset by comparison, these assets go down. Now, I can imagine in the future, should there be a fiat currency crisis where people doubt the validity of fiat, that Bitcoin could be inversely correlated to the dollar, but today that is not true. It clearly is still highly correlated with all risky assets. And so when people are in risk off mode, which they are today, all these asset classes have a tendency to fall. And by the way, the shit coins, if you want, so the altcoins and the ones that are way riskier, have fallen even more so than that. Now, a few potential explanations for this. To me, the most obvious one is in a risk-off mode, capital goes off the system. People have argued that it's also highly correlated with the 4-year cycle that people see. And what the 4-year cycle in Bitcoin is the hash rates divides by 2 every 4 years. And what we've seen historically is in the 12 to 18 months following that, the price of Bitcoin has a tendency to increase. And after 2 years or so, it starts declining, and it's mapped reasonably well in the past. That said, correlation does not mean causation. I can make arguments for why it's less relevant today. The other factors, in this case, the increase in rates, the general bearishness, and then the fear versus greed mindset of investors, we're now more in a fear mode than a greed mode, probably plays a larger role, but interesting to see. Now, the reason this actually, in the case of Bitcoin, may play a pretty significant role is Bitcoin as an asset doesn't have underlying cash flows per se, right? Like the value of Bitcoin is the value people ascribe to it. So it is as valuable as people think it is. And so to the extent that the expectation of this 4-year cycle exists and it impacts people's willingness to invest in Bitcoin, therefore it impacts the price as well. Much less relevant for the other crypto assets because the others have utility, or most of them, or many of them have intrinsic utility and cash flows, right? Ethereum, you're paying the gas fees to build applications on top of it, in which case there's a implied cash flow and valuation relative to Ethereum. It's also not nearly as relevant in the sense that what's interesting is in crypto is despite the fact that you've had these cycles with prices swinging massively, and of course the inflow of capital increases dramatically in bull markets, even in bear markets, and you can see it here in 2017, 2018, and of course the last few months, the assets under management have had a tendency to continue to go up. And so I suspect that this will continue to be the same. This is a good sign for the long-term viability. I mean, when I think of the crypto markets, we're in 1995. I mean, literally, if you try to do a transaction in OpenSea, it's so complicated for most people. The idea that you're going to put the asset in your MetaMask, you're going to connect MetaMask, you're doing self custody. It's so complicated. It gives me like flashbacks to 1995. I'm like literally seeing my modem dialing up, making these horrible noises, connecting these ugly websites with limited utility or functionality, and everything remains to be built. But the fact that even in these bad times, capital continues to flow to the space suggests we're still in the early phases of the creation of the blockchain and crypto markets, and gives me hope that they will withstand whatever there is to come. And it's especially true as Bitcoin is no longer nearly as dominant. Back in the early days of the blockchain, it was over 90% of the value. Today, it's 40% and declining. And use cases have started to emerge, right? It used to be it was really purely speculative. Now, everything from play-to-earn games like Axie, but gaming in general, to having DAOs, to having like valuable decentralized finance offerings, which allow you to make more yield, sometimes in a not too risky way, though of course you can put as much leverage or risk as you want in it, to NFTs, etc. So there are actually use cases which are making me optimistic. That said, like with the public markets, valuations at historical highs, and I think will remain highly correlated with U.S. interest rates. So if we get Volcker 2 and we get rates to go to 10%, all these assets by comparison will seem way less attractive and will decline. I actually don't think that that's the base case, by the way. I think the base case is somewhere between my optimistic case and what is essentially built into the market expectations today. So I guess what all this is suggesting is actually keep a fair amount of cash on the sidelines. This way you can like price average down on the way down. I mean, you're never going to time the market perfectly, neither in the public markets or in crypto in terms of where the real bottom is. From my perspective and what I've been doing, frankly, is just holding everything I've had. And haven't currently been increasing the positions, but probably would, like if BTC fell to 20K, I'd start increasing the position again. Ethereum fell like below 2K or 2.5K, probably increasing a little bit. That said, I can make a case you can still have a lot more to fall. But long term, super bullish in the space. We're like day zero. I mean, not even day one. We're like at the very, very, very beginning. And of course, we're still investing in protocols and applications, etc., as we speak. Now, what does it mean for the private markets? The private markets have been extraordinarily frothy in especially in the lead stage. We've seen more unicorns created in 2021 than we saw in the 5 years combined before. And there's a lag between what happens in the public markets and what happens in the private markets. Historically, when the public markets corrected, there would be 4 to 6 month lag before it started impacting the late stage privates. In fact, last week, I saw $100 million fundraisers announced. Now, of course, these are deals that people have been working on for a month or two, and they're just being announced. Maybe they'd even closed before, but it shows that it hasn't yet completely impacted it. That said, there are now rumors of repricing in the late stage. And in a way that kind of makes sense, especially as it's going to be driven by the crossover funds, right? Like, so imagine you're a Coatue or a Tiger, and you invest both in public markets and private markets. If the public markets have corrected 50% in the categories you're interested in, and the private markets have not, you're going to reallocate capital from the private markets to the public markets. And so it's going to take a while because you have deals ongoing, etc. But eventually you see an adjustment. And this is what's happened in the last different cycles. And now what I'm sharing here is driven by deal size. So it's somewhat correlated, positively correlated, obviously, with valuations, and you don't have the full detail, but this is data I could get on the impact of public market corrections on later stage deals. And so in March, April 2020, when the public markets corrected, we saw that the pre-IPO round sizes fell by 41%, suggesting that most likely we saw a pretty big correction of the valuation as well, perhaps by around 41% as well, with a 3 to 6 month lag. And I suspect that this will happen here as well. Now, what's interesting is the earlier stage startups are less impacted. they're already less impacted in general by valuations. Now, of course, we all saw these crazy deals where a company will raise a 200 pre-50 million Series A, or like the 20 million at 100 pre-seed round. But these, you need to realize, are the exceptions. These were like for third-time successful serial entrepreneur attacking a massive category, putting some money of his own as well. And these were maybe getting a lot of press. But if you looked at actually the median pre-money valuation, it had not gone up all that much. So the median pre-money valuation, I'd say 2015, 2020, it's like 3 to 5 pre-seed, maybe 8 to 10 seed, and like whatever, 17 to 22 at the A. Again, I'm saying median. And what we saw the last year at the median was maybe 6 at pre-seed, 12 at seed, and like 25 to 30 at A. Now, again, the mean went up a lot because these exceptional deals were pushing everything up. But it didn't change all that much. I don't suspect it will change all that much either, and the lag is greater. So multiples will compress. Maybe the expectations of fund returns and exit multiples will compress. It won't change early stage valuations all that much. What's interesting is in April, March 2020, at the Series A, the round size has actually increased. And I suspect it's because there was so much uncertainty. They were worried about what would be happening in Q3, Q4 earlier next year, and they did not want to go to market in what they considered to be really bad conditions. And so people raised more than they needed. And in fact, that would also be my recommendation today. Be extraordinarily thoughtful of burn, unit economics, runway, make sure you have enough runway. I'm not saying get 4 years of runway, but don't raise for 6 or 12 months, raise for at least 18 months, and preferably maybe 24 or more, given who knows what the conditions will be. What this also suggests, if you're late stage right now, you probably want to raise now if you can. Because imagine you grow 50% from now to 6 months from now, but actually valuations compress by 50%, you're going to get the same valuation in 6 months than you would today. So to the extent capital is available today, and of course it's a big if, but if it's there because you've been talking to Tiger and Insight and General Atlantic or whatever, and they're willing to fund you today, even if you don't need the cash and you're pre-IPO, I would highly recommend you take it, because you may not actually get benefit of the growth that you provide in the next year or so if multiples compress, as I expect them to in the very late stage. Now, all that said, there's more capital on the sidelines than there's ever been before. So it used to be that VCs would raise like 50 billion a year, more or less, and there were like 200 funds more or less for many, many years. In the last few years, there's been more capital raised than ever before going after the venture market. We had more than 100 billion raised for the first time ever in 2021, which of course means these funds have a lot of capital to deploy on the sidelines, and we're at over 700 funds now going after the category. So even though I do expect a multiples compression, I don't expect a full-on decimation and ending of investing in venture, because they're not going to be returning the money to their investors. They're going to continue to invest. They're going to be more thoughtful on unit economics and diligence, etc. But there's capital there. So the very good and the very best companies are still going to be able to find capital with no problem at all. And in fact, it shows how extraordinary this period has been. For the longest time, venture, the entire category of venture, was about 50 billion a year that was being invested in startups. And there was 4,000 new seed-funded startups every year with at least 500K. And there were like 6,000 startups being funded every year. Last year has been absolutely exceptional. For the first time, we saw deals. We saw over 300 billion invested, and we saw 15,000 startups being funded. So we've tripled the number of startups being funded in general, and we've multiplied by 6 the number of deals done of capital deployed, because obviously the average investment increased in size dramatically. So the question is, is this the new steady state? I suspect the answer is no. And what does it go back to from a ongoing steady state model on a go forward basis? And this has affected us at FJ Labs in a pretty big way as well, because when we want to raise Fund 3, FJ Labs 3, which we're currently raising, and we've also already closed the first 200 million of it, 220 million of it, we built it thinking, okay, historically, we've invested in 125 companies a year. We suspect we're going to invest in 125 companies for the next 3 years. And as a result, because we're seeing 5,000 companies being created every year, and as a result, we're raising like 400 million, and that's the right size for us. But of course, 15,000 companies were created, which I can actually justify as well, because as everything moved online, we saw penetration increase in digital services in categories that had not really been penetrated before. So all of a sudden, people were willing to do telehealth consultations, to do online education, to interact with their public services online. We're seeing B2B companies or B2B that are moving their entire supply chains online. And that has led to a massive level of innovation with new startups being created to attack these categories that had been barely digitized. And of course, opportunity cost of capital went down. If you were an employee and you were being paid by the state, you're like, in this environment, we're not necessarily going to make a lot of money otherwise. Might as well go and become an entrepreneur. And that explosion has meant at FJ Labs, for instance, that instead of investing in the 125 companies we invest a year normally, last year we invested in 281 startups. Now, had I known that before I started raising, FJ Labs 3, we should have raised like $1 billion, not, $400 million. But the question is this sustainable or not? Or as people go back to work, as the opportunity cost of time starts going up, maybe that changes. And if that's the case, we go back to the old level of companies that are created every year, then actually maybe the fund size we have is correct. So this is something we will keep an eye on for the next 2-3 years as we decide, okay, what do we do in 2024 for FJ Labs 4? There's still a lot of capital on the sidelines, a lot of companies being created. So it's still, really interesting. And by the way, something probably worth mentioning is the most interesting companies of each generation typically come in times of crises. And in the same way that like the most relevant companies of the last decade, like WhatsApp, Instagram, Slack, Airbnb, Uber, all came of age in the 08-09 Great Recession. I can imagine a lot of interesting and relevant companies will have come of age in COVID, or will be coming of age in the coming difficult years that we may have ahead. So what does this all mean for investors? Well, the environment we saw was really frothy. I mean, there were, especially in the late stage, people doing deals with basically no due diligence. They're applying an FJ Labs level of limited due diligence to writing multi-$100 million checks, where deals were being done in like days. And I suspect that we're going to see the return of more discipline, where people are going to do more normal due diligence for writing big checks. Many investors are going to say, okay, wait and see, kind of like that guy reading the newspaper. Let's see how things play out, and let's start adjusting or repricing deals that were maybe exaggerated. Now, what's also interesting is a lot of people have done extremely well in this time period, and so we're seeing many legendary GPs retiring, not just because they've done extremely well after a bull run, but also because, of course, they're coming of age and there's a new replacement level of investors coming in. So VCs are going to be more focused now on unit economics, on burn, on valuation of the companies they invest in. Now, what's interesting is if you're a private investor today and you're stage agnostic, probably makes sense to move earlier in the SEC. And so I suspect that the Tigers of the world, for instance, are going to go from the pre-IPO markets to actually the Bs, the As, where valuations were more reasonable to begin with, given that there's more opportunity there. And so they'll put a little bit less focus in the very late stage, more in the public markets, where, of course, they can play, right? Like if they like food delivery, DoorDash probably might be, or Delivery Hero, probably good investment opportunities today. And they'll go to the Bs and the As. Now, what it means for founders, well, take care of your cash, right? Like you have to be extraordinarily thoughtful about your burn, about your runway. Make sure the unit economics are good and focus on them. We're in a world where the fear, greed mentality has gone from all greed, like all growth at all costs, to more fear. And so really make sure that your economics make sense. Raise at a reasonable price. What people don't realize that what kills companies the most is raising at way too high a price relative to your traction. Because if you do not grow into that price, then you're basically dead. Because people don't want to do Dan rounds, the anti-dilution provisions like wipe out everyone. So many companies that have raised hundreds of millions but don't grow in their valuations essentially die as they're incapable of like raising the next round. And so be thoughtful of the valuation which you raise. Make sure that whatever amount of capital you raise will get you to the point where you can have at least a flat round and preferably an up round on a go-forward basis. Historically, there's been a tendency if you raise more cash than you need to spend it. And so regardless of how much cash you raise, people would like spend it in 18 months. If you happen to raise money because it's there at a good price, don't increase your burn. Like keep it. Keep discipline. Only spend the money you need to grow to grow efficiently. Especially make sure unit economics work. Improve underlying profitability. In terms of the market as a whole, the last few years were absolutely insane from an IPO perspective. I suspect that we're going to see a return of M&A in general, both as strong companies with strong balance sheets acqui-hire or buy the companies that are weaker, and as the IPO markets may close, you can imagine that that more M&A will happen, more exits will come for M&A, both in number of deals and cash. And I think that's basically it in terms of how I see the market and the market conditions right now and in the coming year. And so, just in general, I'd say be more disciplined, be more thoughtful, and focus on be somewhat price sensitive, work on unit economics, your burn, etc. I'm happy to take questions if any of you have questions right now, and if not, I'll share a few more thoughts while you think through your questions. Some people have asked me, okay, what did I think of the SPAC market? What's happened there? So there was a full-on bubble in SPACs about a year ago, and that has completely corrected. To some extent, you could argue overcorrected, but there's been a lot of there's so many SPACs that went to market. There's still like an overhang of deals they're trying to do. So the way I see SPACs, they're a viable, legitimate way of going public. There are many cases I can paint of where it makes sense to use a SPAC, right? So imagine, because the problem with a normal IPO is you have to go to a quiet period. It's actually extremely complicated. And you may leave money on the table through the pop and valuation. Here, you negotiate the price, and it's the opposite. You're actually going and cheerleading and selling your story. And so there are many cases where it can make sense. Like imagine you're a large European startup, and you're considering going public on NASDAQ, but for you, it's very complicated. You don't know what it takes. You don't know how to go through the process. And maybe you do belong in NASDAQ, right? Like if you're $1-2 billion company going to 10, 20 billion, you're not going to get the liquidity that you deserve if you're going public in Europe. Like I would argue Delivery Hero, for instance, that like, I don't know what they're worth today, but they were like a $30-50 billion company, would really belong to NASDAQ or NYC, not on Frankfurt. So if you're that type of company, you really belong in the US, but it's complicated for you to go public in the US, a SPAC may make sense. Here's where I can tell you where SPACs don't make sense. SPACs don't make sense in the case of like these completely frontier tech companies like whatever, fusion financing, potential for a fusion reactor, or graphene batteries, or like anything that's like frontier tech, not proven, no business model, no unit economics. Essentially, the public markets have been funding R&D, but it's investing in a pre-revenue, pre-business model company in the public markets. That doesn't really make sense from my perspective. Now, it's a wonderful thing for the universe, by the way, for the world, right? Like we're having the public markets finance extraordinary R&D. It's a net positive for humanity. But do I think as a public investor, you're likely to make money if that's what you do and you're investing in these SPACs for frontier tech? Probably not. That said, very happy it's happening. It's kind of like, fundamental research financed by the public, which is really fantastic. But SPACs are here to stay as a means of going public. We've seen a correction, and I suspect that there'll be more companies that have underlying profitability, doing pretty well, that will be going public. And we're seeing actually a lot of crypto miners and crypto things happening right now in the Slack world, which I think actually makes a fair amount of sense. So I think we'll see more of that. Pausing for a second, and thank you for all the kind words. I'm not seeing necessarily a lot of questions beyond what I've covered, and what I'll do as usual is in a few weeks I'll post a summary of this and the slides on my blog, and you can see it there. Well, I think that's it for the week. Thank you for actually wait. What do you think about the market of alternative data providers, data as service? Should we see higher valuations after a recent IPO by SimilarWeb? An expansion of DaaS in the SMB market. I haven't looked too much at data as a service companies. In general, though, I take the more mega trend. The mega trend I've seen is companies are doing less and less themselves and outsourcing more and more. So it kind of falls in the future of work where you do the thing you're really good at and everything else is you outsource. And so I can see how be it SMBs or larger companies are doing that across the board for their underlying services, right? Like if you're whatever, Luigi, the pizza store owner, you don't want to build your website, pick up the phone, etc. You want to like hang out with your customers, cook pizza. So you have Slice do a lot of that for you. The same to me applies in the data market. You're not necessarily going to be aggregating or buying your own data. You're going to have data as service providers for whatever it is you may need. That said, I don't know the market particularly well and can't speak to valuations. Okay, well, with that, thank you for joining. I don't know when the next show will be. I have a few ideas and a few guests I might want to bring in, but I'll see you next time. Thank you.